Welcome everyone. Right. Today we are going to study, discuss the topics related to Keynesian theory of national income, which is part of chapter 1, unit 2. All right. It's a pretty lengthy unit, but some of the very most important things we'll be discussing here. And some changes have also happened in the compared to the examination that happened in 2020, which was applicable from 2021 May, and it contains a lot of questions and a lot of derivations that we'll look at later on in various other sessions that we'll be conducting on Unacademy platform on the YouTube. Now, before we go further, so first of all, why to subscribe to Unacademy? You see, Unacademy is 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 has joined hand with the Yashas Academy to provide all English course for every level of CA examination, whether it's foundation, whether it's intermediate, or it's a final examination. And on top of that, a lot of important things and a lot of very wonderful things are available on the platform. For example, you can interact with the teachers just as you do in your face-to-face classes by raising hand, and we can hear your voice when you speak and we can answer your queries. You don't have to write all the time asking queries. So there is a voice chat available for you for that. You can we can take care of your unlimited doubts, whatever doubts you have. Additionally, every fourth session will be a doubt clearing session wherein the faculties will take care of the doubts with respect to the topics taught previously or in the previous sessions. All right, and obviously instant solution will be given to all your doubts. Now, as you all know that there will be coverage, chapter wise coverage, and class notes will be provided to you, and also printed notes will be provided to you. Every point will be highlighted, then will be summary done at the end of every chapter. So as far as subscription is concerned, all right, and as you all know that when you are joining Unacademy, you are taking advantage of the online platform. It will save a lot of your time in transportation, in accommodation when you are living in different city. So that's the one of the biggest advantage of online classes. And when we are providing you the same quality as you get in a face-to-face classes, then you can't nothing can be better than this. So plus subscription for 24 months if you take it, so the per month cost will come to 1000 rupees. For 12 months it will 1500 rupees, and for 6 months 2000 rupees. So you can pick any plan according to your choice. And if you use Yashash code, Yashash Live, this code, if you use, you'll get 10% additionally off. All right. Moreover, in the Iconic subscription, if you take Iconic, have little more advantage compared to plus subscription. So you got to pay a little extra. For 24 months, the price is 2417, and for 12 months it will be 2917 per month, and for 6 months 4167. And again, you'll get 10% off if you use Yashash Live as the code. So you can pick up any plan as you want. Clear? So let's continue with our session now. Keynesian theory of national income. Keynesian theory on national income. Now, Keynes is one of the, you can say, prominent economist, and became more popular during the Great Depression that happened in the 1930s. He published a paper known as Theory of General Theory of Employment, Interest and Money, which in fact almost became a Bible for several years, which was used by many countries to figure out where they stand when it comes to compilation of national income aggregate. And that theory is not only pertaining to the concept of national income, this theory also contains a lot of related things with regard to the demand of money and the supply of money. That again it becomes a part of your curriculum in the chapter 3 when we are studying about money market. Now what Keynes mentioned, he developed 3 deterministic model of national income. Now at first it seems to be very unrealistic when we discuss the first 2 models, but the third model is more realistic. But the thing is, for example, he divided the economy into 2 sector, 3 sector and 4 sector model. In the 2 sector model, right, 2 sector model, 2 sector, he said that there are only households and firms present. Households and firms are present. It means there is absence of any government intervention, and it's a closed economic model wherein taxes, wherein exports and imports are not happening. Now it's a very unrealistic realistic model, because you will not find any economy in the world today wherein only households are there and businesses are there and there is no government intervention. So why do we study about it? You have to ask yourself one thing. Perfect competition do not exist. It's an ideal construct, a theoretical reality. In the subject of physics, perfect machines do not exist. Alright, when the output will be exactly the same as the input. But we do study about those. Why do we study? So that we can figure out that if we know what is the perfect situation, then how imperfect is the situation we can figure out. Right? So it means you are trying to get a benchmark here. So when we in a 2 sector model, as I've told you, there are household and firms, whereas in a 3 sector model, there are households, firms and also the presence of government. So when we compare the 2 and the 3 sector, then we can figure out if there is a change in the national income, if there is a change in the equilibrium wherein aggregate demand and aggregate supply is measured. So this change, what is the level of this change due to the government intervention? So in a 2 sector model, we have only household and a firm. In the 3 sector model, we have household, firm and the government. When the comparison is made with respect to the national income at the equilibrium level in the 2 sector model and the national income at the equilibrium level in the 3 sector model, what is the difference? The difference we can figure it out is due to the government intervention. So it helps us compare the different sectors, and theoretical model can be compared from a realistic model to find out what is the implication. And had this theory been absurd, he would have given up. In fact, he received the Nobel Prize for his paper published during the Great Depression. Now in a 4 sector model, he said, which is a more realistic model, he said that it's an open economic model. It means the first 2 models that we'll discuss are closed economic model. Closed economic model. It means there is no external sector. But in the 4 sector model, apart from households, firms and the government, there is also external sector where imports and exports are happening. So don't you think this 4 sector model is more realistic model compared to the 2 or the 3 sector model? Because we know that no country can survive today in this ever integrating global economy only all by itself. We need technology, we need capital, we need those resources that we cannot produce within our domestic territory, or if there is a scarcity for that particular commodity. No country can survive. And this comparative advantage and disadvantage, it makes trade favorable for several countries who are trading with each other. So that's why 4 sector model is a more realistic model which is present in the world today, but 2 and 3 sector model are unrealistic. But still, when we make a comparison between a 4 and the 3 sector model, then we can find out what is the implication of the external trade that is happening in the economy. And likewise, when we compare 2 and 3 sector model or 2 or 4 sector model, then we can figure out that yes, if there is no government and it's a closed economy, what is the income level, and when there is an open economy and government intervention, what is the level of national income. But remember one thing, there are certain assumptions taken here, because I've told you economics is not a perfect science, it deals with human behavior. So you have to take a lot of assumptions. All right. So what are these assumptions? So they can ask you a small question or a 2-marker question on assumptions. Assumptions. What are these assumptions taken? First, it is said that the methods of production and the price of factor inputs and the goods produced do not change. All right. That is, the methods of production and price of factor inputs and output do not change. In fact, there is no inflation basically in idealistic two-sector model, you can say. So second, the government sector do not exist. So there is, if you are tracking now assumption about a two-sector model, then you can write that now the assumptions will be, most of the assumption will be same in a two-sector, three-sector, four-sector model. So when you are writing assumption for a three-sector model, just you have to ignore the second assumption, that is no government presence is there. So you will write that there is a presence of the government. So one more assumptions we have to add. So you have to subtract one and add one. So if you know the assumptions for a two-sector model, more or less all the assumptions in other sector models will be the same, except you have to just strike down one and add another one. So there is absence of any government intervention. Government do not exist, and that so when government doesn't exist, then government will not be able to affect the market through expenditure and taxes. All right. Third, it is a closed economic model. It means what? There are no exports or imports taking place. No exports or imports taking place. Then we also assume that investment is considered to be determined autonomously or indigenously. So it means one firm or one household will not be able to determine the investment or autonomous investment. See, Keynes had given a short-term model. So in the short run, it is always assumed that investment remains constant. All right. So investment which is determined autonomously is assumed to remain constant. It means it doesn't get even affected due to the change in interest rate. So changes in interest rate, you can write here that changes in rate of interest do not affect autonomous investment. Now there are no retained earning. It means all the profit earned by the businesses are distributed to the shareholders as dividends. When the profit is earned by business, they have three things that can do with their profit. First, retain that profit for future expansion or taking care of future contingencies. You can distribute it as dividend to the shareholders, or you can use it for current expansion. You're not keeping it for future, using it for current. So here we say that there are no retained earning. It means whatever profit is earned by the firm from the sale of goods and services, it is completely distributed to the shareholders. It goes back to the hands of the shareholders, the subscribers of the equity shares. All right. So there are no retained earnings. That is, entire profit earned by the firms are distributed as dividends to the shareholders. All right, clear. Now then we study about what is the circular flow of income in a two sector model. Circular flow of income. So you see, you remember one thing, that household own all factor inputs. We say 5 M's: men, money, material, methods and machine. These are the factor input which goes to the businesses, which helps in the production of goods and services. Now you can say, sir, businesses own resource. How does the household own resource? No dear, the household own resource, all the resource. That's why you see, when you define economics, a very important word, Greek word, from where the see origin of the word economics is there, which is oikonomia, which means management of household. Now household, why it has been given such an important relevance by every economist in the world. All right, past, present and obviously not future. We don't know what is going to happen in future, but yes, household, because you see, labor do not belong to business. You all are preparing to become a CA. One day you will become CA. Do you think the company that you're joining, they have financial studies, or your parents have financial studies? So it means labor is borrowed from the household. If one fine day every CA says that we are not going to work for any company, do you think it is easier for the company to operate in that case? If every scientist said that I am not going to work for any business, do you think big firms, whether it's a Facebook or Apple or any other technology or IT firm, they will all collapse? So the labor belongs to the household, right? Then you say, sir, finances also belong to the household. Where from the businesses will raise money? They will go to the bank to borrow. But the thing is, whose money is there in the bank? The money belongs to the public. It is the public deposit from where the bank is lending the money to the businesses. Then you can say, sir, they can float an equity share in the market, like Zomato did it sometimes back. All right. Okay. Who is going to subscribe to the equity shares? Apart from other businesses, they will also subscribe, but household retail subscribers will be significantly higher. So then you said machinery. Machinery, one business purchases from other. You said men, material, machines. How come machine is produced by the household? Tell me dear, a business is producing heavy equipments and heavy machineries. Who is working in that business? That is run by labor, which has been provided by the household. Will that particular company from where I am buying the machinery to run my business, will that company be able to manufacture that machinery if there is no labor which is provided by the household? If there is no capital which is provided by the household? The answer is no. So everything, all the resource input is owned by the household. Households, they promote businesses. Businesses do not create households. Households, they create business. Humans, we belong to the household, we create business. Businesses do not create household. Now, household, obviously, if you find a common general definition of household is a place wherein group of individuals live. Right. Now, in a circular flow of income, when we have to define circular flow of income in a two-sector model, circular flow of income. On one side, you have a household. On the other side, you have firms. Now, the factor inputs are provided by the household to the firms. So, this dotted line will tell you the flow of factor inputs. Factor inputs. Now, factor input goes from the household to the firms. These are factor inputs, without which the firms cannot produce anything. Alright, men, money, materials, whatever, the factor inputs are provided by the household. So, when the households are providing the factor inputs, they have to be compensated with some payment. If I am putting my money in your business, I will have to share you will have to share the profit with me. I'm a shareholder. If I'm giving you a loan to your business, I will receive the interest from you. If I'm giving my labor, whether skilled or unskilled, I will receive wages or salary. If I'm giving you premises where you are going to set up your factory, I'm going to lease you a land or a building, I'm going to receive the rent or the lease fee. So the factor inputs, when it's provided to the firms will provide back. This continuous line shows monetary flow. Continuous line shows monetary flow. It means the firms will have to make payment to the household for the factor inputs they are being provided with by the households. Alright, so this is monetary flow. So this is known as factor payment. Factor payment made to households. HH, I'm writing household. It means what is this factor payment? Wages, salary, interest, rent, profit, etc. Alright, so you can write here wages, rent, interest, share of profit, etc. Now, don't you think the factor payment by the firms to the household, if somebody's expenditure will become somebody's income? So can't I say that factor income received by the household is equal to the factor payment made by the firm? Correct? Alright. Now the household, when they receive the factor payment, which becomes a factor income for them, what they will do with that income? They will use it for consumption expenditure. Alright. Okay, then we will say, sir, some of them will save also, no problem. When they are saving, the money is going to the bank account, or the bank, financial intermediary, the bank is going to again lend to businesses. It means whether you save or you consume, the money is flowing back to the businesses. So now you will use the money that you have received to pay to the firms. Again, continuous line which shows monetary flow. So that will become what is known as consumption expenditure. That is, you will purchase goods and services produced by the firm. So don't you think my consumption expenditure, if I'm a part of the household, will become revenue income for the businesses? So my consumption expenditure will be equal to the revenue earned by the businesses, and then the firms will channelize the resources back to the household. It means in the form of goods and services sold. Alright, so goods and services. So it means the circular flow of income is complete in this case. Alright, so can't I say here in the end, can't I say, looking at this, that whatever factor payment made by the businesses is nothing but the factor income received by the household? Factor income of households. Whatever the factor income of the household will become consumption expenditure for the businesses. Consumption expenditure for the household. And whatever is the consumption expenditure I'm spending to buy goods and services, that is nothing but receipts by the firm. So revenue receipts by firms, and eventually I can also say that this will be equal to the value of output, because if this pen has been produced by 100 rupees, it means 100 rupees to the factor inputs have been paid. That will be used to buy the goods and services. It means it flows back to the firms. Alright, clear? So that completes the circular flow of income. Now let's look at the concept of aggregate demand and aggregate supply. So when I say aggregate demand under Keynesian model, demand or AD, it consists of two things. That is, one is C, one is I, C plus I. Now what is this C and what is this I? This C pertains to consumption of consumer goods. Now here broadly we define consumer good doesn't mean only the which are not durable goods. Everything that is purchased by us, whether it's a car, whether it's a everyday item, and so on and so forth. Clear? Consumption of consumer goods. And I stands for consumption of investment goods. It means when a household or anybody who wants to, because see, consumption is all not only taking place by the household, consumption is happening by the businesses as well, because businesses are not only selling, businesses are also buying factor inputs, and one of the factor inputs nothing but the plants and machinery that you have to purchase from other businesses. So say for example, if I want to set up a power plant, do you think I want to generate electricity, do you think I will also produce power plant? No, I will buy power plant, or the machinery, the big what do you call it, transformers from some other company that is going to manufacture it for me. So that purchase is going to be considered as consumption of investment goods. Now why I am consuming the investment goods? So that this consumption of investment good will give me return in future, it will help me produce something. All right, so this is known as consumption of investment goods. All right, consumption of consumer goods, consumption of investment good. I'll come to the concept of supply side later on. All right, so now you see here, so we can say that AD equals to CI, aggregate demand equals to C plus I. So we know that investment is determined endogenously or autonomously. It is an assumption taken under the Keynesian model of national income, whether it's a 2-sector, 3-sector or a 4-sector model. So investment is considered, you have always to assume that investment is determined autonomously or endogenously, and so in the short period of time it is assumed to remain constant. In the long run it may increase, and we have also a theory which says that what happens if the investment is increases eventually. So that concept will be again studying further later on when in the concept related to investment multiplier. But for now, in the short run, and Keynes largely focused upon the short run concept, so he was largely focusing on the demand side picture rather than on the supply side picture, because supply side picture cannot be changed in the short run, but demand side picture can be changed in the short run. So aggregate demand and that's why he said that one of the fundamental reasons why there was a great depression in the 90s, that there was a significant fall in aggregate demand, that pushed the economy to the brink of collapse, because all the businesses, they had unsold stock to the extent at a significant or massive level, and they had to undercut or shut down their production in a very short period of time. During that great depression, somebody says 20%, somebody says 15%, and somebody says 25%, but even if I consider 15%, global GDP was wiped out in a matter of less than 2 weeks by 15%. Even if you consider 10%, it's a big deal. So aggregate demand and consumption of consumer goods, consumption in investment goods. Now we know is determined autonomously. So we say that in the short run, I remains, not is, I, or you can say I is assumed to remain constant. So sometimes I is also written as delta, I bar, not that bar, I bar, it means fixed. All right. Somebody asked, no, how you define bar? We said bar is a place wherein people go bar. So anyways, poor joke. So let's go on further. Consider now. So I can write aggregate demand also as C plus I bar. Now let's understand consumption function. This consumption C is also, or if you want to appropriately denote it, we call it as aggregate consumption. Because it consists of two things. Later on we'll see what are these two things. But tell me logically, you see, economics is all about logic. If you understand it logically, nobody can teach you economics, because it's all around, it's a part of your life. Every day we are taking small decisions, big decisions based on resource allocation. Whether it's a small business, big business, the government, a household, wherever we are taking a small decision to the big decision, it's related to economics. So it's all around you. And if you understand this phenomena, then the economic laws have been derived from the behavior of the people. If you understand your behavior and how people behave, then everything is very simple. It becomes very simple. So That's why I said nobody can teach you economics. You have to understand economics. Once you understand, because one of the beautiful subject, and it is multidisciplinary, it will open up your mind to a lot of things that's happening around the world that you do not understand right now, but yes, you will understand as we go on. That's why in my session I basically give so much of you know uh, not so much of information that you'll not find in your ICI book, right? But when you relate to what I'm teaching to the stories that I tell you, and those are not the story, those are the fact that has happened in the past, could be happening in the current situation as well, or may happen in future, you can speculate as well, then you can realize how beautiful is the subject it is. So aggregate consumption. Now consumption function, if I say, when I say function, what do I mean? Function is nothing but it shows or denote the relationship between something independent and something dependent. For example, when you talk about production function, the relationship between input and output. When you talk about revenue function, it's a relationship between the revenue generated and the sales that is happening. So likewise, when I say consumption function, we say that consumption is a function of income. Consumption is a function of income. That is why, isn't it? Don't you think we consume according to what we earn? So do you think there is a direct relationship between consumption and income, or an indirect or inverse relationship? Obviously, logically, when you make more money, your earning increases, your income increases. Will you not buy more and more of many goods? Today you are living on your parents' income. Tomorrow you will become a CA. Do you think your consumption will remain in the same way when your income was zero and you have to borrow money from your parents to take care of your demand, take care of your satisfaction? Do you think the consumption remains same? No, consumption increases. You'll go crazy. Oh my god, such a nice time, I'm getting so much of money in my bank account. Always you will open up the app and see, oh my god, okay, this much of income. Pehle 5,000 rupiya tha, now 5 lakh rupees. What will I do? You'll dream at night, what the hell, okay, I'm employed now. So your consumption increase, you will be buying more and more. You'll become a part of the consumer group. Still you are consuming, but you are not earning. Your consumption is dictated by the income of your parent, not your income. So anyways, consumption, logically, what does logic says? That there is a direct or positive relationship. Direct or positive relation. It means what? As income increases, the consumption will also increase, and vice versa. Logical hai. As income increases, consumption will also increase, and vice versa. So consumption function, it shows what? It shows the relationship between income and consumption. How much there be a change in my consumption if there is a change in my income, and they move in the same direction. It means higher the income, more the consumption, lower the income, less the consumption. All right. So now so clear. And here income is dependent, income is independent, consumption is dependent on income. All right. So we'll write it, how we'll write it? Consumption, will write, is a function of income. So there is a direct relationship between consumption and income. Now I've told you this C is also known as aggregate consumption, because it's a summation of two things. We say aggregate consumption, that is C, is a summation of autonomous consumption plus induced consumption. Autonomous consumption is denoted by A and induced consumption is denoted by BY. So I can say that C equals to A plus BY. Now why is this autonomous consumption? We call it autonomous because something is autonomous, it means it doesn't depend on anything. It means it doesn't depend on anything. So investment, if I'm considering autonomous or indigenously determined, it means one factor or a couple of factors not going to bring about a change in the investment. It remains constant. Likewise, autonomous consumption also remains constant. Maybe not forever, but in the short period of time, it will remain constant. All right. So what is this consumption? The basic necessities that we have to consume. Without food, we cannot survive. Without water, we cannot survive. Without medication, we will not survive. Do you think the consumption of these things depend on my income? Absolutely not. You will beg, borrow or steal, you will consume the necessities or you have to die. As simple as that. The consumption of these commodities cannot decrease with the decrease in your income, because your survival will be at stake. Moreover, when your income increases, the consumption of these commodities will not increase. Will you buy more medication when your income increases? Absolutely not. Then you can say, sir, I'll buy more food. Yes, maybe, but in the short run, you will not. Suddenly your income increases, you will not start buying, okay, your grocery bill was 10% of your income, it will increase to 30% of your income. It may increase by a small margin, but that too will happen slowly over a period of time. So in the short run, we assume that autonomous investment, or A, is assumed to remain constant. This is what been stated under the Keynesian model by Maynard Keynes. Then what is this BY? BY is known as induced consumption, as I've told you. Induced means what's motivated, something that has been induced by something. Alright, inducement hai. Alright, for example, a monkey is sitting over there, I'm staring at him, he is staring at me. We will not react. But if I take a banana out of my pocket, the monkey will come running to me or jumping to me. That is inducement. Induce kiya my monkey ko. Alright, so in the same way, when anything is induced by something, that is induced consumption, and we say that that is dependent on the factor that is inducing it. So induced consumption is that part of the consumption that depends on your income. It means higher your income, more will be the consumption. Lower your income, lower will be your consumption. So this induced consumption, BY, I have told you, induced consumption, that is, it is dependent upon the level of income. That's why we call it as induced consumption. What is happening? Just hold on. We call it as induced consumption because it depends on the level of income. So induced consumption changes with the change in the level of income, because it is consumed as a proportion of income. Now what is B here? B will be studying as marginal propensity to consume. But for now, let's understand B is the proportion that is of income that is spent on consumption. For now, let's understand in this way. B is marginal propensity to consume. We'll study separately what is the relevance of V. A lot of relevance of B is there, of marginal propensity to consume. But for now, if I have to write what is B, B is nothing but the proportion of income that is spent on consumption. That is proportion of income which is spent upon consumption. And what is Y? Y is the level of income. All right. Now let's understand one thing here, very important, that will help us understand the diagram or the illustration that we'll take up next. Tell me, when my income is zero, can the consumption be zero? The answer is no, because we cannot survive. We are not machines that you can lock it up because the production is not happening, and then after the COVID, when the demand will increase, you just open up and clean the machine and start working. It will die. We are human beings, so we will have to consume minimum in order to stay alive. So even when your income is zero, your consumption will not be zero. Then you can say, sir, if my income is zero, current income is zero, if I don't have money, how can I consume? We can understand in the 3-sector model, government is there to give me the subsidy. But in the 2-sector model, I don't have income. How can I consume? The answer is, You can consume from your past savings. You can consume from your past savings. Okay, that is a possibility. All right, clear. So let's say y is equals to 0. Let's say value of b is 0.3 and the value of a is rupees 200. In the second case, let's take value of y as 1000, value of b as 0.3 and value of a is again 200. And in the third case, value of y, let's take it as 5000, value of b is same and value of a is same. So only income is changing. So you can compare that what happens due to the change in income if all other factors remain same. Right. Now if I have to find out the aggregate consumption here, we know that aggregate consumption is a plus by, correct? Now a, I know rupees 200 is the value given in the question. B, I know that is 0.3 multiplied by y, which is 0. Anything that is multiplied by 0, doesn't matter how much giant is the number, the value will be 0. So I can say the value here will be 200 plus 0, so that will be equal to 200. See, so don't you think I can say that when the income is 0, the value of aggregate consumption will be equal to the autonomous consumption? So we can say when y equals to 0, then C equals to A. Can't I say that? Obviously I can say that. Now let's figure out what happens over here in the second case. Now if I want to find out consumption here, then again I will have to write in the same manner A plus by. Now I know A is 200 as it is in the previous case, B is 0.3 and now income is 1000 given. So now 200 is my autonomous consumption and 300 is my induced consumption. Not 3000, 300. 300 is my induced consumption. So it means my aggregate consumption will be, which is a summation between autonomous consumption and aggregate and induced consumption, will be 500 rupees. So don't you think the income increased from 0 to 1000? You see my consumption is also increasing, but the aggregate consumption is not increasing due to the change in autonomous consumption, because autonomous consumption is not going to change. Likewise, if you see here, this is consumption function. I'm explaining how relationship, what is the relationship between income and consumption. You see, as income increases, consumption also increases, if despite the fact that the value of B is not changing. So C again equals to A plus by, correct? So the value of A is again 200 and B, as in the previous all cases, 0.3, but here income is 5000. So now autonomous consumption remains same as 200, but induced consumption is increasing to 1500. So it means aggregate consumption increases to 1700 from 500. So if I take care of this induced consumption, you see here, don't you think my income is increasing 5 times from 1000 to 5000? 1000 into 5 is 5000. My income is increasing by 5000. Don't you think my induced consumption is also increasing by 5 times? Because the proportion remains same. So let's look at the illustration that you will that's very interesting and easy to draw. Right. So let's say here the y-axis we show consumption. All right, and the x-axis will show income. All right. Now tell me, do you think I will have the value of A, you see, it will be a straight flat line. This is A. Why? Because as I go along the y-axis further away from the origin, income is increasing, but the value of A is not increasing. It means the value of A remains constant here. It means if I am spending rupees 200 on A, it will remain the same whether my income is 0, whether my income is 1000 rupees, 2,000 rupees, 3,000 rupees, 10,000 rupees, the value of A remains the same. Now one more thing, do you think consumption, aggregate consumption line will start from here? If I increase the, if I write it in this way, aggregate consumption, is absolutely wrong. Why? It means you are saying it at this point where income is zero, consumption is also zero. So when you are consuming at this point at the origin, it means consumption is zero. It means A will also become zero. That is not a possibility. So what happens here, if I have to draw a consumption line, I'll have to draw from the point from where A originates, because we know that when the income is zero, C will be equals to A. So now we can write here C, this is your consumption line, which is nothing but a function of income, right? Clear? So how much is the proportion is will be determined by B. Now why this is a straight line? Why can't this be like this line? Because the proportion is remaining constant. So it means if the proportion of B is, let's say, 0.4, it means when my income is 1000, my induced consumption will be 400. If my income is 10,000, that is 10 times, that my induced consumption will increase to 4,000. If my income is 1 lakh, then my induced consumption will increase to 40,000. If my income is 1 crore, then my induced consumption will increase to 40 lakh. It means 40%. So as much as the increase in income is there, by the same proportion the consumption is increasing. That's why it's an upward sloping straight line. So now if this consumption is increasing, this line is there, it is not increasing due to increase in A, because A is not changing. So it is increasing only due to increase in the induced consumption. Alright, clear? That is BY and not A. Alright, clear? Now let's come down to the concept of B, that is marginal propensity to consume. Now remember, marginal propensity. When I use the word marginal, means you change of one. In your foundation you must studied about marginal cost. What is marginal cost? What is the additional cost incurred when the output increases or changes by 1 unit? Marginal product, how much will be the change in the output if the input changes by 1 unit? Marginal utility, what is the additional utility obtained from the consumption of 1 additional unit of any particular commodity? What is marginal revenue? What is the additional revenue generated from the sale of 1 additional unit? Likewise, here also marginal means change of 1, but here we are talking about consumption. So it means now we have to find out that what will be the extent of the change in the consumption when there is a change in the income by 1 unit of a rupee. So if I have to write marginal, marginal is always a change of 1. So marginal propensity to consume, that is MPC. What does it denote? What does it denote? It denotes the relationship, or you can say it denotes how much will be the change in the consumption when there is a change in the income by 1 unit of a rupee. So by how much will the consumption change when the income changes by 1 unit of a rupee. Alright, by 1 unit of a rupee. So if I have to find out marginal propensity to consume, then what we have to do, what is the formula for the same? Change in consumption due to change in income, or change in consumption by change in income. So change in consumption divided by change in income, or sometimes we also write it as, MPC is delta C by delta Y. That is marginal propensity to consume. It means what happens to the change in my consumption, by how much the change in consumption is happening when the income changes by 1 unit of a rupee. Now, sometimes we also have to find out average consumption. What is average consumption? Now, marginal consumption is a consumption, change in consumption due to change in income. But average consumption is consumption per unit of income. It means if my income is 1000, consumption is 200. So it means how much of income is going towards consumption of 1 unit of the commodity. So that will be your aggregate consumption, your aggregate income divided by aggregate consumption. Alright, aggregate consumption. So if I have to write APC, marginal propensity के बाद APC, if I have to write average propensity to consume, let me write it fully. So average propensity to consume, we say as APC, it is what? Consumption per unit of income. It shows was APC shows consumption per unit of income. So if I have to write APC, what we have to write is total consumption by total income. That is simply I'll write aggregate consumption by income. So that's the difference. Remember, don't get confused. Marginal is always a change of one. It means by how much is the change in my income, and as to with respect to the change in my income, if it's 1 rupee, how much is the change in now in my consumption? So the change in consumption due to change in income, by how much the consumption is increasing or decreasing when the income increases or decreases by 1 unit of a rupee. But average propensity to consume is total consumption. It means how much in aggregate I am consuming and what is my level of income. All right, clear? Okay. Now savings function. Let's come to savings function. Remember, this marginal propensity to consume is known as B. This MPC can also be written as B. All right, that was the proportion of my income that was spent on consumption. So you can write MPC or you can write B. Now let's understand something about savings function. Now remember, whether it's income function or saving function, consumption function or saving function, they both depend on income, isn't it? Don't you think rich people, they have more savings, poor people, they have less savings? Right or wrong? So don't you think higher the level of income, not only your consumption increases, but your savings also increases, right? So we can say that savings function denote relationship between income and savings. How it is denoted? We say saving is nothing but a function of income. And what is the relationship? Logically, again you think direct and positive. So direct or positive relation. That means what? If income increases, savings will also increase and vice versa. Correct? But also remember dear, we say that income can either be consumed or it can be saved. Income can either be consumed or it can be saved. Many of you will think, sir, ye kya bol diya? Why can't I consume and save at the same time? You see, this is not the meaning of the statement that I have written. Of course, when you are earning some income, you can save as well and you can consume as well. But when I say income can either be consumed or it can be saved, what I mean is that part of the income that you have already consumed, you can never save. If suppose your income was 100 rupees and you have consumed 80 rupees out of your income, now can you save anything more than 20 rupees? Tell me, the answer is no. Alright. Sir, will this be done in the regular class? To which batch do you belong, dear? Yes, it will be done in the regular class as well. This is on the YouTube session, dear. YouTube sessions are free for many students so that they can figure out that yes, there are quality faculties and interactive sessions available on an Unacademy platform. So this will be available. Are you a student? Have you already joined? Hmm? This is intermediate year, intermediate economics of finance, chapter 1, unit 2, Keynesian theory of national income. Now income can either be consumed or can be saved. It means what? That part of the income that I've consumed, I cannot save anymore. So what is remaining that has not yet been consumed, I can save that only. So again, a direct relationship. So when I say income can either be consumed or it can be saved, it means that part of the income that I have consumed, the remaining is the saving. Or I can also write down that part of the income that I'm not consuming, that is saving, the remaining will be consumption. Or I can also write it as that savings plus consumption is equals to income. Anything is the same equation written in 3 different ways. Right or wrong? Clear. So there is also something known as marginal propensity to save. Now it comes. Marginal propensity to save. Now what is marginal propensity to save? It means by how much is this increase or change in my saving if there is a change in my income. So we call it as marginal propensity to save, MPS. So marginal, again the change of 1, alright, change of 1. It means if my income changes by 1 rupee, how much will be the corresponding change in my savings? Alright, so what does MPS shows? What does MPS shows? MPS shows changes in savings due to change in the level of income by 1 unit of a rupee. So remember, when for my class, economics class, you don't have to read any book, just stick to the class notes and don't worry, you can get distinction. So because I try to make things simple for the students' perspective so that they can understand easily. So marginal propensity to save by, if my income was here, how much was my saving? If my income is here, how much is my saving? So if my income is changing by 1 rupee, how much is my saving? So how do I find out what is marginal propensity to save? Marginal propensity to save, just like marginal propensity to consume, we will write here change in saving due to change in consumption. Changes in savings divided by change in income, or we can also write it as delta S by delta Y. Alright, but I have also told you income can either be consumed or it can be saved. So it means if my income is increasing by 100 rupees and marginal propensity to consume is 0.6, it means out of that increased income of 100 rupees, 60 rupees I am consuming, only 40 rupees I can save. So it means if 60 is the marginal propensity to consume, automatically 40 is the marginal propensity to save. Are you getting it? If suppose the value of marginal propensity to consume, that is B, is equal to 0.6, it means whatever is the increase in my income, I am consuming 60% of my increased income. So if suppose my income increases by rupees 1000, it means my consumption will increase by rupees 600. So how much is left? How much is left? Left is rupees 400. By 400 is, what is the percentage way? 0.4 or 40%. So don't you think 0.4, that will be my savings? So can't I write here that 1 minus MPC equals to MPS? अब देखो, what I did here, 1 minus initially what, 0.6 of my increased income I am consuming, so remaining what I am saving, that is 0.4 I am saving, Baba. Correct or not? Alright, so MPS is 0.4. Sir, no, this is not foundation, dear, this is intermediate. Alright, this is intermediate. So I can also write it here as 1 minus MPC is MPS, or 1 minus MPS is MPC. So I can write here marginal propensity to consume plus marginal propensity to save equals to 1. Alright, this is the relationship. So we'll keep it up to this. Tomorrow we'll continue this session wherever we left off, and we'll continue the concept of equilibrium in a two-sector model that we'll be studying. Right, tomorrow you'll have the same timing, that is from 2 to 3 o'clock in the afternoon, special session on YouTube. So please feel free to join in. Knowledge is wherever you get it is good enough for you, at some point in time is going to help you. So if you have time, please join in. Take care, and if you have not yet subscribed to Unacademy, please do so as soon as possible. And so many plans and subscriptions and flexibilities are available, and there'll be no difference as far as face-to-face or the interactive online sessions are concerned. All right, bye bye, take care and have a nice time.